Wow, so things have been a little bit out of control lately. Nothing but negative news every single day, and we have a stock market that is completely driven by emotion and what the Fed Chair Jerome Powell says out loud. That being said, it is exactly times like these that we can be confident as a dividend investor. There are some great deals out there on high quality dividend stocks. Here are 5 dividend stocks with deep discounts to take a closer look at. So these 5 dividend stocks are all available at a deep discount. Now, when I say that, I am comparing their current dividend yield against their historical 5-year average dividend yield. All 5 of them are selling at a discount between 26% and 41%. All 5 dividend stocks have a history of raising their dividend at least 14 consecutive years, all the way up to 47 consecutive years. All of them have a dividend yield north of 3%, and most important of all, they all have very stable free cash flow. When I say that, I mean that despite the craziness we have experienced in 2022, the level of free cash flow being generated by the businesses hasn't been seriously impacted. Given these factors, let's dive in. The first dividend stock we are looking at is Republic Bancorp. Ticker symbol RBCAA. Republic Bank and Trust Company is a regional bank and operates banking centers in 5 states: Kentucky, Tennessee, Ohio, Indiana, and Florida. They've been raising their dividend every year now for 24 consecutive years, and they currently yield 3.44%. Now, historically, their average yield has been approximately 2.55%, which is a discount of 26%. Republic Bank also has a strong and consistent dividend growth rates at 9.3%, 8.7%, 8.9%, and 7.6% over the past 1, 3, 5, and 10 years. What is really important about Republic Bank is they have very steady and stable free cash flow. Free cash flow is the measure of cash left over after paying all business expenses and reinvesting as necessary back into the business. This is clearly a good way to measure dividend safety when you compare the level of free cash flow to the amount of the dividend being paid. Does the company generate enough cash flow to pay the dividend? This dividend payout ratio for Republic Bank is 34% for 2021 and only 21% for the trailing 12 months, which incorporates a good portion of 2022. This tells me the dividend is safe right now and is capable of being increased in future years. This dividend stock is not currently in my portfolio as it does not have sufficient option premium available for me to sell covered calls. Otherwise, all metrics point to being an excellent dividend stock to pick up right now at a great discount. Okay, the second dividend stock we are looking at is Walgreens Boots Alliance, ticker symbol WBA. Walgreens Boots Alliance is a combination of retail pharmacy storefronts, aka Walgreens, and a pharmaceutical company, Boots. They have been raising their dividend every year now for 47 consecutive years and currently yield 5.85%. Historically, their average yield has been approximately 3.76%, which is a discount of 36%. You'll notice Walgreens does have a lower dividend growth rates here more recently, 2.1% over the 1 year, 2.8% over the past 3 years, 5% on average over the past 5 years, and 7.8% over the past 10 years. But then again, this is a dividend stock with 47 consecutive years of dividend growth. Walgreens Boots Alliance has a 1-year dividend payout ratio based on free cash flow of 33%. And if you look at the trailing 12 months, this number does increase to 48%. This number is higher, but it's still very low, as only 50% of extra cash flow is needed to pay the dividend. This dividend is very safe based on this ratio right now, and again capable of being increased in future years. Walgreens has been in my portfolio previously but was called away from me due to a covered call being exercised. It is definitely a dividend stock I will be looking to add back to the portfolio if the opportunity arises. Alright, the next dividend stock we're talking about is Universal Health Realty Income Trust, ticker symbol UHT, which is also known as a REIT. A REIT is similar to an index fund, but for real estate. Instead of going out and buying rental properties all by yourself, you can instead own shares of UHT, which owns many different real estate properties already. Specifically, UHT specializes in healthcare and human service related facilities in states across America, including Nevada, Texas, California, and Arizona, among others. UHT has been raising their dividend now every year for 37 consecutive years and currently yields 6.47%. Historically, their average yield has been about 4.12%, which is a total discount of 36%. UHT has lower but very consistent dividend growth rates of 1.4, 1.5, 1.5, and again 1.5 for the 1, 3, 5, and 10-year average dividend growth rates. The 1-year dividend payout ratio based on free cash flow is 84%. And 83% for the trailing 12 months. Yes, these percentages are definitely higher than the previous two dividend stocks, but REITs are required to pay out at least 90% of their taxable income every year in order to get special tax status. So it's normal to see elevated payout ratios for REITs. The key in looking at this metric is the stability in the trailing 12 months, which includes all of 2022. Despite the market volatility we've seen, UTH continues to generate significant and stable cash flow. The dividend is safe and very stable. This dividend stock is not currently in my portfolio and is also not on my radar because it does not have sufficient option premium available for me to sell covered calls. The fourth dividend stock we're going to talk about is currently in my dividend portfolio, and that is Rowe Price. Ticker symbol TROW. Rowe Price is an investment management company that offers investment management services to both personal and institutional investors. They have been raising their dividend every year now for 36 consecutive years. The current dividend yield is 4.47%, which is much higher than the historically lower 5-year average yield of 2.72%, which is a total discount of 39%. Rowe Price has excellent dividend growth rates of 15.2%, 16%, 15.5%, and 13.4% over the past 1, 3, 5, and 10 years. These dividend growth rates are amazing and realistically cannot be sustainable at this level long term, but they are still great nonetheless for now, considering current inflation rates. Rowe Price has a very healthy 1-year dividend payout ratio based on free cash flow of 59%, and it's even lower at 35% over the trailing 12 months. Based on these ratios and metrics, this dividend is safe right now and capable of being increased in future years. Like I said earlier, I currently own Rowe Price in my own portfolio, and I'm looking to add additional shares of this dividend stock soon. Alright, the fifth and final dividend stock we're talking about is also in my dividend portfolio currently, and that is Comcast Corporation. Ticker symbol CMCSA. Comcast is a media conglomerate with multiple business segments, including cable communications, cable networks, entertainment films, and theme parks. Comcast has been raising their dividend every year now for 14 consecutive years. Their current dividend yield is 3.39%, which is higher than the 5-year average yield of only 2.01%. This is a total discount, though, of 41%. Comcast has very consistent dividend growth rates at 8.3%, 9.4%, 7%, and 11.9% over the past 1, 3, 5, and 10 years. Dividend growth rates at this level help insulate dividend investors from our historically higher interest rates right now. Comcast has a very stable dividend payout ratio based on free cash flow over both 2021 and the trailing 12 months at 42% and 34% respectively. The dividend is very stable at these levels and insulated from a dividend cut based on what we know. I own Comcast myself, like I said, and I write covered calls on this position. The reality is there are so many dividend stocks here, and hopefully these 5 that I highlighted in this video might be options for your portfolio as well. Hopefully you found some value to the video. Make sure to leave your 2 cents in the comments below, as I always appreciate your feedback. Thanks for watching.